Hello there. Welcome to Insurance World TV, where we break down insurance beyond the policy document. In today's video, we're answering a very important question. How financially stable is your insurance company right now? We've already talked about International Financial Reporting Standard 17, commonly abbreviated as IFRS 17, and risk-based capital, or RBC. But today, we zoom in on one of the simplest and most powerful financial indicators in insurance, the current ratio. We'll explain what it means, why it matters in the claims-paying ability of an insurer, where to get the data, how to calculate it step by step, and most importantly, how to interpret the results to make informed decisions, whether you're a corporate client, a broker, or a policyholder. If you want to understand an insurance company from a financial strength perspective, you're in the right place. Let's get into it. Question 1. What is current ratio? Let's start with the basics. Current ratio is a financial metric used to measure an organization's short-term liquidity. In simple terms, its ability to meet obligations that are due within the next 12 months. In insurance terms, it helps answer a very practical question. That question is, if this insurance company had to settle claims and other obligations due in the next 12 months, does it have enough resources to do so? That's what the current ratio is all about: short-term financial strength and ability to meet short-term obligations. The formula is straightforward. Current ratio equals current assets divided by current liabilities. Current assets are resources that can be converted into cash within 1 year. Current liabilities are obligations that must be paid within the same period. Question 2. What counts as current assets and current liabilities for an insurer? For an insurance company, current assets typically include cash and bank balances, short-term investments, premium receivables in form of amounts owed by policyholders or brokers, and reinsurance recoverables due within 1 year. Current liabilities usually include outstanding claims payable, claims incurred but not yet paid, unearned premium liabilities, trade and other payables, and short-term borrowings. This is important because insurers are claims-paying institutions. And because of that, liquidity for them is not optional, it is fundamental. Question 3. Why does the current ratio matter in insurance? The current ratio matters because it answers one critical question. Can this insurer pay claims and obligations as they fall due, without financial strain? A strong current ratio suggests better claims-paying ability, lower liquidity risk, and stronger short-term financial stability. A weak current ratio may indicate potential delays in claim settlement, dependence on asset sales or borrowing, and higher operational and reputational risk. For policyholders and corporate clients, this directly affects confidence and service reliability. Question 4. Where can one get the data for calculating this ratio? You can calculate the current ratio using publicly available information. Look for the data either in the insurer's audited financial statements, the statement of financial position, that is, balance sheet, annual reports published on the insurer's website, or regulatory filings submitted to the Insurance Regulatory Authority, IRA. All the numbers you need are usually clearly labeled under current assets and current liabilities. Question 5. How does one calculate the current ratio? As given earlier, the formula for calculation the current ratio is by dividing the current assets by current liabilities,
i.e.,
current ratio equals current assets divided by current liabilities. Let's use a simple example. If an insurance company has current assets of 10 billion Kenya shillings and current liabilities of 5 billion Kenya shillings. Using the formula and the data given above for illustration, to get the current ratio you divide 10 billion, which is the current asset, by 5 billion, current liabilities. The result can be presented in either of the two ways. First method, whole number form,
e.g.,
10 billion divided by 5 billion equals 2.0. Therefore, current ratio for our insurance company above is 2.0. The second method is by converting the result into percentages,
e.g.,
10 billion divided by 5 billion multiplied by 100% equals 200%. Accordingly, the current ratio in this instance is 200%. Whether presented as a whole number or a percentage, the interpretation achieves the same outcome. In our illustration above, it 2.0 means the value of assets is twice the value of liabilities, or 200% meaning the assets exceeds liabilities by 200%. This means the insurer has 2 shillings in short-term assets for every 1 shilling of short-term obligations. For any 1 shilling claimed, the insurer has 2 shilling from which to pay. Actual interpretation is that, in this case, the insurer has a healthy current ratio and they can easily meet their short-term obligations using their short-term assets without any strain. Question 6. How are the results interpreted? Interpretation is where insight really begins. Current ratio above 1.0 or 100% means the insurer can meet its short-term obligations. This is generally acceptable. Current ratio between 1.5 and 2.5 or 150% to 250% in terms of percentages is often considered healthy for insurers, depending on business mix. Current ratio below 1.0 or 100% is a red flag. The insurer may struggle to meet near-term obligations. A very high current ratio, i.e. 3.1 plus, or over 300%, is not always positive either. It may suggest inefficient use of assets or excess idle cash. In every instance, context matters. You must consider the insurer's line of business, claims volatility, reinsurance arrangements, and market conditions. Question 7. How can one use the current ratio to make informed decisions? For corporate clients and procuring entities, compare ratios across multiple insurers, track trends over several years, combine the current ratio with other indicators like the claims ratio and capital adequacy ratio. For brokers and risk managers, use it to assess insurer liquidity before placing large risks. Monitor changes that may signal financial stress. For policyholders, a stronger current ratio often means faster, more reliable claims payments. Final takeaway. The current ratio may look simple, but it is a powerful window into an insurer's financial discipline and short-term strength. It does not replace IFRS 17 or risk-based capital. It complements them. When used correctly, it helps separate financially stable insurers from those operating under silent pressure. That brings us to the end of our discussion on the current ratio. We've looked at what it means, why it matters in assessing the financial stability of an insurance company, how to calculate it, and how to interpret the results to make informed decisions. In our next video, we'll be shifting focus to the claims ratio, also known as the claims coverage ratio, where we'll examine how insurers manage claims experience and what it tells us about pricing, risk, and long-term sustainability. Be sure to stay with us.